Hello, everybody. It's John Browning on the Building Your Life podcast. Today, we've given Michael DeLon the day off again, which he's very appreciative of. And we have Bruce Weinstein on the call with us today. And Bruce is everything insurance and a little bit more on top of that even. I'll let him talk a little bit more about what he does and how he got to where he is today, which is a pretty impressive place, Bruce. And we're really happy to have you on the podcast today to talk about this. But the reason that we're having you on today is because a big part of comprehensive wealth management involves insurance. And that's not something that I am an expert in. This is one of the things we talk about on the Building Your Life podcast, is building a team around what we do here at Guardian Rock Wealth of people that we know, we like, and most importantly, that we trust. And Bruce, you are definitely one of those people. So we're really excited to have you here today. One quick housekeeping item is that this is not investment advice. So if you're looking for that, please give me a call. You can text the word life to 21,000. And that involves a really deep conversation, getting to know you and really developing what it is you want, and more importantly, why it is you want that. And then we manage to that outcome. So nice. If you want that, this is general information that we think you're going to find some value in. So Bruce, introduce yourself a little bit. Tell us kind of how you got to where you're at right now.
Thanks, John. I appreciate it. So it's Bruce Weinstein, Weinstein Wealth Insurance Solutions. My wife and I live down here in Delray Beach, from New Jersey originally. Spent 30 years up in the Princeton market as a financial advisor and asset manager like you, but we sold that practice in 2016. And then last year we launched Weinstein Wealth Insurance Solutions to focus solely on the insurance side of things. So now I collaborate with people like you and help their clients understand a deeper sense of insurance, but I still have enough, fortitude over the years from the insurance side and the scars and the such. So, we're happy to be here. To your point about investment advice, there's a line I came up with the other day is I don't manage people's money, or I don't anymore anyway, but we don't manage people's money. We manage people's expectations. And I think that goes to what you do most. Is it's not about the investment. It's about what you're trying to accomplish. And then having those expectations set, whether it's insurance related or investment related, it's life related. What are your expectations? What are you trying to get from point A to point B? And then people like you and I help people map that course with the least amount of exposure for risk standpoint. True?
Well, Bruce, I tell you, when I talk to people about insurance, when I look at their entire picture, and I talked about people about insurance, one of the things that they really, it tends to be like the pain that hits them right here is paying that insurance premium. And they're like, why am I doing that? Can't I self-insurance on all this stuff? And there are certain cases that I do find that people are kind of a bit overinsured for what they need in their specific situation, which is again, why I really like working with you, is because you're not one of those guys that is looking to over-insure. You're looking to get the appropriate amount of insurance. What would you say to someone who is just like, oh, I just don't want to pay that premium? What's the main value of insurance? Why would you want to pay that premium?
So it's a great question. I'll give a couple of points around it. Is we are a very heavy insurance-based society in this country. You're going to drown in all the insurances that are available. And so you've got to prioritize your needs based upon your current financial situation. And then eventually things fall off and other things replace it, and it evolves to, different things. So a younger family might just need some inexpensive term insurance, but then when they get into their 50s or 60s, they might need long-term care insurance. A young person working or a self-employed professional might need disability insurance to protect their income. Because if you and I get hurt or get sick or in an accident, who's running the shop? Nobody's bringing in the revenue. I better have disability insurance to make sure I'm paying my bills, right? So life is going to dictate certain things. Nobody likes insurance. Nobody likes paying for insurance, but they like having it when a crisis occurs. And so, do I hear belly aching? Yeah, all the time, of course. Like people are just gagging, and I get it. Health insurance, especially, probably one of the worst environments historically for this country. Life insurance can be relatively inexpensive for a lot of people and fill a big gap and void, but health insurance has gone crazy. So,
yeah. And, one of the things that you have done that I've seen you do is there's a big discrepancy between one health insurance and the next health insurance as far as cost goes. And more importantly, what a lot of people tend to not pay what I think is enough attention to is what's covered, how much is covered, when is it covered, all of those nuances of insurance. That is the reason we hire a guy like you to keep it straight. I mean, can you give us, I think you gave me an example earlier. We were chatting about somebody that you saved, like one guy you saved 10 grand a year, and I think
30 grand.
30 grand.
30 grand. I got another client for 30 grand, but yeah, I was telling you about one earlier about just about 10.
I mean, yeah, how does that happen? Like, give me a little backstory, like how in the world is, don't give any names, obviously, but
no,
that's amazing.
No, I have no names.
Yeah.
So it's amazing what people don't know. And even more, probably not surprising, because you and I deal with the public for so many years, is people just don't really bother that there's a level of apathy to check. So in the insurance world, you should reshop every now and then, depending on what it is, whether it's your auto, your homeowners, or whatever, right? So in this particular case, we had a family that moved from New York 4 years ago and moved to South Florida, for those listening outside the South Florida market, Boca Raton, Florida. And not really knowing otherwise, kept his health insurance plan, which was a New York-based plan. And his latest statement was getting a 15% rate increase and was now exceeding $3,500 a month for a family of 4. Okay, that's $42,000.
Yeah.
On top of that, he then complained that it doesn't cover anything down here. So why am I paying all this money? And I'm looking at him and I'm like, you got a New York plan. People don't realize, like, at least for health insurance, it's very regional based, literally by county. So his New York plan would only be good if he was in New York, but to see regular doctors, hospitals, whatever, he's always out of network, which of course you don't get the same coverage. So we did some homework and we gave him some options, and we were able to get him a better plan with lower deductibles, lower maximum out of pocket, which is lowering his overall exposure. And we saved him $30,000 a year.
Oh my goodness.
He wasted $120,000. No, his rates weren't that high 4 years ago, but still $25,000, $20,000. He probably wasted $100,000 because he never picked up the phone or checked with somebody to say, hey, did you move down here from New York? What did you do? Right.
Right. Yeah.
That's insane. That's a lot of money. So as you hear me speak at different events and groups or whatever, I'm like, you owe it to yourself to always check.
Yeah. And I'm thinking too, as people age out and retire, this is a big thing that I talk to people about, because most people, it never really crosses their mind. Maybe they think about it a little bit. It doesn't really cross their mind that right now their employer is paying at least a portion. It may not seem like it. It may still seem painful, but when you retire, who's covering all of the healthcare cost?
I found over my financial advisory days and helping people plan for retirement, it was the number one, not the investments or the performance, the portfolio, but their probably biggest concern was the health insurance expense and obviously long-term care, right? Which was, later on thing. But to get them over the hump to accept retirement was having a clear understanding of what their health insurance expenses and exposures were, especially pre-Medicare age, which is 65. So if you and I wanted to retire at 62 and we're getting $1,000 a month health insurance plan from our employer covered, am I getting that when I retire at 62? Are they offering me that in retirement benefits? Most corporations don't provide that anymore. Federal jobs, government jobs, local municipalities might offer medical, but very rarely does corporate America offer it. They're still out there, but it's less and less and less because it's choking, it's choking everybody. So, for you, if you were to do it and you say, well, what do I have available that can be as comprehensive and not break the bank? Well, then you have to do your homework. And then eventually you have to build it into your budget, right? If you're going to retire at 62 and whatever age, 55, we want you to retire as early as possible, right? So life's too short to not. But you got to put it in your budget.
And you mentioned long-term care insurance, and you and I have talked. My wife and I used to run a business up in the Chicagoland area that was providing people care in their homes rather than in a home. We sold that business a few years back, but we saw the need for long-term care insurance in a big, big way, and we saw some really great stories from those who had it, and we saw some really sad, difficult stories from those who didn't. And I understand. So back in the past, we'll just say back in the past, long-term care insurance kind of got a bit of a bad name because the insurance companies didn't charge, frankly, enough, right?
They underestimated their actuarial tables, right?
Yeah.
I've been doing, I don't need to cut you off. So I've been doing long-term care. I've been doing long-term care planning with clients since the early 90s. So 25, 28 years.
You've seen it all. Yeah.
So, we were in the early part and we built it out, again, part of the budget. Today, there's more of a hybrid product with life insurance, but back then it was straight long-term care, assisted living, home care options and riders, lifetime coverage, which was open-ended, right? Like not just a 5-year plan, but a lifetime coverage plan. And then I framed it as there's Cadillac, there's Chevy, and there's Hyundai. And I'm not disrespecting other cars, but there's different levels of cars or services. So
no Tesla? No Tesla.
There was no Tesla in 1994, but
all right.
I wish, right? We could have been early investors.
Yeah.
So, you could say Mercedes, whatever it is, but, you had the high-end car, which was a high-end level of long-term care insurance. So if you could afford it, plenty of people buy Cadillacs, and there are plenty of people that buy Hyundais, right? And then some people buy Chevys in between. So the long-term care conversation was the differences in the level of coverage, the length of coverage, and then the costs. And so where my clients, and most of them bought these, they bought lifetime plans with a 5% COLA. And then we used the average prices in the New Jersey market at the time, which was between $150 and $200 a day. Okay. Fast forward 15 years later, and the .com and the Gulf War, and then, these financial crises that were coming about. And all of a sudden, the 65-year-old they sold long-term care to is 80 and 85. They haven't died off. They're living longer. They're in a nursing home for 3 years, and they're going to live to 100. And the nursing home insurance has to pay for this. And that's a cash register that's just ringing and ringing and ringing. And so what happened, and this goes back, a good 10 years ago since the reset, is all the clients got letters, and they were basically saying, this is going to be the new rate, which is unheard of, or for the same price, way up. And they, again, I don't know what the audience is privy to, or you understand, and I'm not trying to be too technical, but an insurance company cannot just raise rates randomly and say, John's a bad risk all of a sudden. They have to go through a regulatory approval process with the Department of Insurance and justify why the rate increase is necessary and have the data and the statistics behind it. And so they have to say, look, we made an actuarial miscalculation. The average life expectancy was 78. Now it's 85. We're going to be, going belly up if we can't raise the rates, because they can't come after just the individual. So they have to raise the whole group. And of course, the regulators are like, well, we'll let you do a 20% increase. We can't let you do 40. So they started to slowly ratchet up the rates over a couple of years. So that all the clients got letters, and we basically had to decide, pay more or take a little bit less. And then depending on their budgets, we had to recalculate, what they took. But you can't find a product today that gives you lifetime coverage. Doesn't exist. And most of what you're seeing are sizable premiums, $10,000, $15,000 as standalone coverage. So, what I used to do for 3 to 5, maybe 6,000 a year is triple the price, if you could even find it.
One of the things, though, and correct me if I'm wrong, is that at least with the new policies, or many of the new policies, they have a life insurance component to it. So,
Right.
One of my complaints with those plans was, well, what if I never need
Right.
long-term care? I paid all this money and
Right.
premiums, but now you can get it with some life insurance, right?
Correct. So I mentioned a hybrid product. That's what I was referring to. It's a combination of life insurance with a proportion of the death benefit paid towards long-term care. So that one way or the other, let's just use $500,000. You have $500,000 of life insurance, and you get 2%, which is $10,000 a month, paid out for long-term care. Now, $10,000 may not be enough, depending on where you are, what you are. This is just an example, okay, for math purposes. So that's 50 months of coverage before you run out of money, okay? Now, you and I at our age, God willing, we won't need it for 30 years. So, when I'm 88 and I finally need this, is 50 months enough? Probably, I don't know. But if I never use it and I got hit by a bus at 67, my family gets $500,000 paid. So one way or the other, the money is coming in and returned. And to your point, a lot of people were like, I'm going to give you $6,000 a year for 20 years and never get a penny back if I just died. And that was built into their calculations. So that did evolve, where we had policies for a period of time that, I don't know your wife's name. What's your wife's name?
Christine. Yeah.
Christine?
Yep.
So it was basically a joint pool of money, not an individual pool of money. So I'd get you 3 years, I'd get Christine 3 years. You had 6 as a family. You die and never use it, God forbid, she's got 6 years. Now, if she dies, it's gone. But at least, you were able to buffer some of that exposure as a couple. And then even later on, they got into the non-forfeiture type conversations where premiums were refundable, so that, you at least got your money back if you never used it. But again, that costs more money. So the premiums just keep going higher, where people are like, oh, I can't do it.
Right. Well, and I think too, for the people listening on this podcast, one of the things that I like to say, because people think of things, well, I got to do it all. That's not necessarily the case, right? You can guard against a portion. It depends on what your budget is and where you are. And that's why we say this is not investment advice here. This is not insurance advice here. This is just general information that we hope provides value to the listener.
Right.
But I wanted to make sure, by the way, before we end, that Bruce is a fantastic resource. I want to make sure, Bruce, what's the best way to get in touch with you?
We got a couple of different ways you could try and reach us. So we've got our website, which is WeinsteinWealth.com. My last name, Weinstein Wealth. I've got text the word Plan Man, all one word, to 21,000. Like John has his life, I have Plan Man. We're getting a 800 number I got back, 844 Plan Man. But we have a current number, if you can see it behind me, is 844-4WE-COVER. So you can call, you can text, you can hit the website, you can email us, multitude of ways. Obviously, they can come to you if.
Yep, you can come to me too. If those that know me, I can get you in touch with Bruce. And like I said, he's a fantastic resource. But I'm really super stoked that you came on the podcast today. We want to have you back, maybe to drill down on maybe some very specific things.
We can talk for hours.
Yeah, we could. We could just keep on going, right? But I want to let people get on with their day. But thanks so much, Bruce, for sharing a little bit of value.
I'm going to have you on mine. Is it okay to plug?
Yeah, absolutely. Tell us that this is a brand new podcast, right?
Yeah,
so tell us about your podcast. This is awesome.
In fashion of John and what he's done, I've been motivated and encouraged. So we're going to have Ask the Plan Man launching as a podcast, which is tied to the Text Plan Man, in February. And it'll be similar to what you and I are doing here is you'll come on mine and we'll collaborate some more. We're going to bring on real life questions, real life candidates, or case study, if you will, where if you weren't in the business, you would say, you know what, my wife and I are dealing with this. So we're going to make it, my subtitle is everything you wanted to know about finances and insurance, but we're afraid to ask. So it's a safe forum, a safe environment. I kind of joke, I want to be the Dr. Ruth of, insurance. So, what are your problems and how can we help? And then, from investment side, people like you will be brought in to, collaborate with them as those needs, because we don't do that side anymore. And then we're just here to help the public like you are, is be informative and influential in the knowledge. We're doing it too long not to share the wealth of knowledge. So
yeah, there's just so much stuff out there that people just don't know, that we just know is second nature because it's what we've done for the past 30 years.
Right.
So if we can help people by listening to the podcast, awesome. Right. So it's, what is it again? One more time with your new podcast.
So Ask the Plan Man. Ask the Plan Man. So,
all right.
Thanks. Great. Appreciate it. Thanks for having me.
All right. We will see you. I'm going to see you probably sort of the end of this week, right?
Friday.
So I'll see you on Friday.
Thank you, my friend. Appreciate it.
We'll see you.